Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone, and welcome to Coasting in Retirement. I'm your host, Josh Knoll, and I'm joined by my co-host, Michelle Lee Melton. Michelle, how you doing?
I'm doing well today. Thank you.
Good. Are you cooling off?
Yes.
Yes, got a little hot in here.
It did.
In Jubilee Studios. Well, it's great to be back here with you, recording here in Daphne, Alabama. Now, first, for those of you new to the show, quick background on me. My name is Josh Knoll. I'm a fee-based financial advisor based in Fairhope, Alabama. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. So we serve clients up and down our part of the Gulf Coast. You can find more information on me and my practice by visiting gulfcoastfa.com. That's FA as in financial advisor. Or you can always give us a call at 251-327-2124. We will repeat that contact info several times throughout the show. So Michelle and I are here today. As always, we're going to discuss financial topics that are relevant to those in or near retirement, living their best life along our part of the Gulf Coast. We're going to dive into our topic of our opening segment here shortly. But before that, I want to kind of lay out a couple of our segments. Again, if you're new to the show, make sure you stick around. In about 15 minutes, we're going to do Michelle with the news of the week segment. It's great. It's a lot of fun. And then we follow that up with our third segment, about 30 minutes in, called Where Josh Nailed It, where Josh was a little off. Stay tuned for that. We're also excited to announce a new final segment where Michelle and I are going to discuss things of local interest to folks that live down here in Lower Alabama. I'm not going to tell you what it is. That way you stick around till the end of the show, but I will give you a hint. It's about a local town that just got a six-page spread in Southern Living.
Thank you, Rick Bragg.
There you go. So yeah, before we get into all that though, for today, for all you investors out there, particularly you pre-retirees and retirees, you're definitely going to want to hear what our main topic is going to be. So as we get into that, Michelle, there was a movie called Everything Everywhere All at Once that recently cleaned up a bunch of some awards show. I think it was called the Oscars.
Oscars, also known as the Academy Awards, but it did very well throughout the awards season, and the Oscar is the penultimate of that.
Very good.
Will.
Well, can you just briefly explain a little bit about the movie for the three people that haven't seen it at this point?
Okay, it is a great movie. It's long, but it's in segments, everything, and all, so it's broken up, so that's cool. But it's about the metaverse, and really, it's a feel-good movie, and it's about how you should love your people no matter what, or how they're acting or whatever. So it's temporary. Love, love, love. Well,
it's also about different alternative universes and realities, right? Yeah, the metaverse. And so in the movie, and this is not a movie review, that's for my son Peyton's.
Already happened.
Yeah, seen it all. He does that on his podcast. But for this episode, it's the lady is living her worst version of her life. And so that's kind of what it feels like a little bit going on right now with the stock market. We're recording this here on March 22nd. The market just had a pretty significant correction today. So we're going to call this episode Everything Everywhere Financially Falling Apart at Once. Okay, so listen, as in the movie, it feels like there's a bunch of different timelines and potential outcomes our economy could take based on the decisions of our leadership. And our leadership, that could be the Federal Reserve with how it handles interest rates, with the FDIC, how it handles the ailing banks, even politically, with what we have going on with Russia and China and how Congress will handle this banking failure, things like that. There's a lot going on. And a lot of it's got to be handled correctly for us to have any chance at avoiding a recession, the soft landing that everybody likes to point to, and we'll talk more about in this episode. So it's times like these where you will sometimes see investors consider a flight to safety, kind of a course of action. Now, let's say this, like any forward-looking financial advisor will tell you, or they should tell you, your decisions that you make in the moment need to be weighed against the purpose of your invested money, plus your risk tolerance, plus your time horizon. If you have a well-designed portfolio that's assembled for a specific purpose, then my general suggestion would be for you to stick to your plan. Now, of course, you have to have a plan. So if you don't, it might be a good time to give us a call to discuss assembling a comprehensive financial plan to address some of these issues. But all that said, the point of this, it's this. The options we are going to discuss today are for those of you out there that may be that you're fearful of what path to take in the short run, or maybe you haven't used a financial professional in the past, and you're thinking that might be a good time to start. Or maybe you just simply got cash parked in the bank and you don't know what to do with it. And in these times of uncertainty and heavy volatility, I don't blame you. There's a lot going on. So hopefully when we're done today with this episode, we can give you all a couple of things to at least consider. So first, let's do this. We're going to quickly list a handful of options that are generally considered low risk. Then we're going to dive into one particular option that may be attractive to some investors out there over the next handful of months. With that said, again, remember, all investing involves risks. And for the most part, everything listed here generally trades that low, quote unquote, low risk for low return. So there's always a trade-off there, or typically a trade-off. So here are some options for those of you all trying to figure out what to do in the short run. There are high yield savings accounts at banks, right? There's certificates of deposit, CDs, not the music CDs that Michelle refers to, but CDs at banks. There's treasury bills, treasury notes, treasury bonds, tips. There's fixed annuities. One example would be a multi-year guaranteed annuity, what is called a MYGA for short, that gives some type of guaranteed interest rate over a period of time. Okay. And then finally, there's money market funds. Later in this episode, we're going to talk to you all about how some folks would include dividend paying stocks and preferred stocks on this list. But for now, we're going to stick with what is generally considered the lowest risk choices of the bunch. So listen, we've discussed some of these investment choices in greater depths in our past episodes. So what I'll do is encourage you all to go to our website, gulfcoastfa.com, go to the podcast tab, and there you can find our previous episodes if you want a deeper dive on some of these individual securities and products. So for example, like we did a deep dive on annuities on episode 3. For this segment of this episode, we're going to concentrate on money market funds. I'm not going to be discussing bank-based money market funds because if you listen to our last episode about the recent bank implosion, then you heard me make it very clear that I am a financial advisor. I'm not a banker. So for this brief discussion, we're going to talk about money market funds available through advisors like me to potential clients and investors like you. Normally, and I say normally, as in the past 10 to 12 plus years, financial advisors wouldn't get too excited about discussing money market mutual funds because the rates were kind of historically low. What's happened, the recent interest rate hikes has translated to some reasonably attractive rates. Again, for those of you trying to figure out what to do in the short run anyway. There's a couple broad types of these money market funds I have access to. One we'll call prime money market fund. That's going to be primarily based on very short-term corporate bonds. Another one would be on municipal debt. So that's going to be stuff that's issued by state or local governments. And then the other is going to be treasury-based money market funds. All of these funds typically hold extremely short duration securities. For example, the corporate-based fund will have things like corporate repurchase agreements. I know it's kind of an unwieldy word, but they're really designed to be for a week or shorter in term. The treasury-based money market fund can be comprised of treasury bills and things such as repurchase agreements again, but those that are fully collateralized by the U.S. Treasury securities. The bottom line in all this is, while these funds are not guaranteed by the FDIC as a bank-based fund would be, again, not a banker here, they are still generally considered low-risk investments, particularly the treasury-based funds, because the securities in there are going to be backed by the full faith of the U.S. government, which, newsflash, the FDIC is backed by the full faith of the U.S. government as well. So there's some tie-in with all this. So listen, with that groundwork laid out, let's talk turkey. I'm going to give you all a general idea on current rates. I'm going to give yet another short disclaimer. Remember, these rates on these money market funds will change daily, and a significant securities purchase of any kind, even if it's in these relatively considered low risk investments, should not be made without a conversation or at least consulting with your advisor or your tax professional. This particular part of the segment of our episode, it's not considered, I'm not trying to do a solicitation for the sale or purchase of any securities. I just really want to let you all know the general types of interest rates that are available on money market funds, because I don't think my industry does a very good job of conveying that information. I typically use Charles Schwab and Fidelity as my primary custodians. So what I'm going to do today for sake of brevity is I'm going to stick with Schwab base money market funds for my examples. Here's a couple examples. Schwab has a fund that is a U.S. Treasury money fund. There's no minimum on it, or if there is a minimum, it's very low. Some of these money market funds will have $1 million minimum. I'm not quoting those rates today. We're going to do things that a normal investor would be able to purchase. As of today, and we're March 23rd here in 2023, it's going to be offering in the low fours, around 4.2 yield. It's a normal person would call that interest rate, so yield. Schwab's also got one that is a little bit more based on the corporate bonds. That's bumping up against 4.5. Again, I want to be really careful on both being super specific because these rates change a lot. I don't want somebody getting attached to that. And two, this is not a sales pitch. It's just information on what some rates are available out there. Simple, be the same as if you called up somebody and said, "Hey, list me the rates," or found it online. Also, they've got a municipal based debt fund called their municipal money fund. The municipal funds in general, we're going to pay a little bit less than the corporate based or the treasury based, but it's still in the mid to high twos on that. So listen, as we transition to our next segment, one more time, I want to talk about something. It may seem that everything everywhere financially is falling apart at once, but as we go through this episode and as we end this first segment, I want you all to take two primary takeaways. I think that will help you in your short-run decision making. First, for those of you that have an investment portfolio or a financial plan that was well thought out and designed, stay the course. Okay, make adjustments, but stay the course. Now is not the time to make rash decisions. For those of you that don't have this professional guidance or are not happy with your current guidance, of course, we can help, right? That's one of the reasons we do the radio show, is to let people know that we're out here and we're available to help. Second, for those of you that are sitting on the sidelines or possibly sitting on some cash in the bank, the rates that are being offered right now on money market funds are the highest that we've seen in years. That's a no-brainer on that, right? So if any of these situations applies to you, and that is you need investment advice, you need financial planning, or you're just simply looking for a quote unquote low risk place to park your money and get a decent interest rate, why don't you pick up the phone and give us a call at 251-327-2124. That's again, 251-327-2124. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance. And this past week was certainly an example of big news in finance. Every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those in or near retirement. So if you would, join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned.
Hi, I'm Michelle from Coasting Your Retirement, a show that you might have heard on Sundays at noon. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting Your Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week Michelle and I scour the interwebs, or what she calls the interwebs, for helpful financial articles related to our topic of the day, especially those articles that pertain to those in or near retirement. Michelle and I are going to help you all understand and decipher the deeper meaning of these headlines, or at the very least provide some context. So without further ado, here's Michelle with the news of the week.
Okay, thank you. All right, Josh, I'm going to jump right into a site we've used before, bankrate.com. They have a recent article titled 10 Best Low-Risk Investments in March 2023. What is the problem here? It should be 7. Everybody likes 7. It's everybody's psychological favorite, period. I've already done the research. See other
Not 9
earlier
or 11.
episodes.
It's got to be 7.
7 because 7 colors of the rainbow, 7 continents.
All right,
It's inbred in us,
All
for
right.
real. Okay, so I see that Bankrate mentions a couple of obvious choices for this type of list, such as savings accounts, but the interest rates are typically low.
Typically, usually.
CDs and treasury securities. But I was a little surprised to see stocks and annuities listed. And I also have not heard of some of these, just for funsies. Series 1 savings bonds.
Okay. Yeah,
Yep.
old school, but yeah.
Okay,
Okay.
maybe that's why. It's too old. But anyway, can you explain how stocks and or annuities can be considered a low-risk investment in March 2023?
All right, so a couple things. Two quick things to say about this article. First, the list that they have really applies to any time, not just March 2023.
I thought that was very specific.
Yeah, I think they did that. They titled it that way to maximize SEO, to be found on search, like we did. And second, I don't know if I would necessarily categorize any stocks as low risk,
Right.
even dividend paying stocks. So, I mean, one just has to look back at 2008 to see that some of these types of holdings lost 20 or 30%, just like a growth company would have. So, but to be fair. So with that said, let's quickly explain what Bankrate is referring to here. First, dividends paying stocks are just a common stock, a form of a common stock of a publicly traded company. It's like any other common stock. The difference is that certain companies tend to be both profitable and typically committed to sharing that profit to its shareholders via what's called a dividend, hence the name dividend paying stocks. Think of it like the old blue blood type of companies, 3M, Coca-Cola, Verizon, etc. Those companies aren't necessarily in growth mode, but they are profitable, and they're really about holding on to their market share and keeping their shareholders happy. Consequently, they send out a dividend. These type of stocks, they also tend to be a little bit more stable, typically, than growth-oriented stocks and companies, hence their inclusion in this article. But remember, these companies do not have to pay dividends on common stock. In fact, sometimes in their history, they've stopped dividends when they've gone through a rough patch. Now, preferred stocks are going to be a little different than dividend stock or common stock. They're going to have features that are a little bit more like bonds. Just like any type of common stock, their value can fluctuate significantly. But I think they're included on this list of low-risk investments because preferred stocks have a regular cash payout. And if a company misses that cash payout or dividend, they have to make it up to the preferred stockholders before they make it up to the common stockholders. And we won't go too far down a rabbit hole, but there's sometimes enhanced voting rules to preferred stock, but that's enough for today. All right, and then so for the sake of time regarding if annuities are considered a low-risk investment, Michelle, what I'm going to do is I'm just going to point our listeners to our website, gulfcoastfa.com. If you all will go to the podcast tab on that page and scroll down until you see episode 3 of Coasting Retirement, it's titled "Are Annuities Good or Bad?" That will actually give you a full conversation and context for why the reasons for Bankrate would include annuities on this list to begin with. So, all right, very good. So that's what's going on. Are those low risk investments? I mean, you got to be really careful with that, but that's what they included them because of those particular reasons when it came to dividend paying and preferred stocks. So good find. What you got next?
Okay, well, P.S. I meant to tell you that I got a note from your buddy Charles Schwab that they've absorbed my stocks
They've absorbed your stocks
from Ameritrade.
Oh, okay,
started
yeah.
off as E-Trade, I guess.
Yes.
I got that email. Okay.
That's right.
All right. I feel good about it though.
Yeah, Schwab. Yeah, it's
Yeah.
a well-known custodian.
Okay. All right. So next up is a very uplifting article. Just kidding. It's a buzzkill. It's from Business Insider and it's titled "Brace for a Crash Landing as the U.S. Economy Barrels Towards Recession. Top economist David Rosenberg warns." This title was sensational enough that I did some quick research on the author, and it come to find out he actually is a little bit of a curmudgeon when it comes to the economy, which fits in his writing. So, yeah, he even refers to himself as Eeyore in one of the interviews. Anyway.
Eeyore,
so,
the donkey from, what's that?
yeah, Sad Pants,
Pooh?
Winnie the Pooh.
Okay.
Yeah, he's like always moping around.
That's funny.
Eeyore. Yeah, it's his least favorite. Not a huge Pooh fan anyway. But
Right.
anyway. Okay, Rosenberg calls for the S&P 500 and housing prices could fall 25% this year for both S&P 500.
Yeah,
and
he's saying
housing
for
prices.
both, right?
Okay, wow. Okay. Whoa, what do you think?
Well, so I'm going to be honest. I've not heard of this economist before. He appears to be pretty well known, especially for being kind of doom and gloom, like you said. At least he looks like he's got some self-awareness about that. But I went ahead with the research we did. I read enough of his stuff to say that I think it appears he's coming from an honest place. Yeah, that he has legit concerns about the economy, especially as it relates to interest rates and inflation. I don't think this was a total clickbait grab necessarily. But here's a couple things. I don't necessarily agree with him on housing. while I do think there will continue to be some price adjustments in housing, the fact is we have a nationwide housing shortage, especially in growing markets. We've got restrictive building regulations and NIMBYism and things like that makes it hard to build adequate housing. So I don't know, 25% sounds pretty severe. I don't necessarily see that happening. But the bottom line is, here's the thing. Let's say he's right, and for the stock market, if you will, and we have another 2008 type of recession, which would have been 25% plus 30, 40%. I do think he's being a little hyperbolic, but again, I'm going to play devil's advocate for a minute. If you're an investor and this guy Rosenberg is right, how you handle that kind of drop depends on your age. It depends on the purpose of the money that you invested. If you're still in accumulation mode, if you're still working, you got more than 5 years to go in retirement and you don't need this money anytime soon, then my suggestion is, if that does happen, if Rosenberg is right, just quit checking your account balance every 10 minutes and look at this as a kind of a potential buying opportunity at a long-term discount. Again, long-term. Now, if you're in or near retirement, that's a different conversation. You're trying to preserve capital as much or more than just grow it. So you need to take a different approach. There's a variety of investment tools and strategies that we use at Gulf Coast Financial Advisors to preserve capital, or at the very least match up with a low risk tolerance and conservative investments. Even though all investments involve risk, there are ways to dial that down. If you're interested in learning more about that, why don't you give us a call at 251-327-2124, or of course you can email me at jnull@gulfcoastfa.com, set up a conversation. Yeah, great article, Michelle. Yeah, definitely Dr. Doom and Gloom there a little bit. What you got next?
Okay, our next article comes from an actual newspaper where your hands might still get inky.
Right.
And not just a news site. Although I did get it from the electronic site. The New York Times says, forget stock predictions for next year. Focus on the next decade. I like the author's attitude. His name is Jeff Sommer, I think, yep. And you can hear the exasperation through his words. And I think it's pretty telling that he claims that the median Wall Street forecast since 2000 has missed the target by an average of 12.9 percentage points a year, which is pretty sad. I mean, it's 2023. I really have no confidence in these people.
Right.
It's okay. So, do you agree with what this author has to say? It seems like they've missed the beat because they're all mad. Start over. They need to be fired.
Yeah, I'm glad you found this, because I think I have a healthy dose of soothsaying skepticism, just like this author does. And I think he's an interesting writer. I love the paragraph from the article, and I quote, "It's simply impossible to forecast the path of the markets 6 months or a year ahead with any accuracy or consistency, as many academic studies have shown. That the financial services industry continues to label these unreliable numbers as forecasts is a triumph of breathtaking chutzpah, a technical term for shameless audacity." I mean,
nice.
well done, Jeff Somner. So I would say, see Mr. Sad Pants, the economist we had from our previous article, as someone with shameless audacity to some degree. And I meant to tell you this as we were doing research. Shameless Audacity would be a great band name, almost like maybe a Winger tribute band name. Shameless Audacity. What do you think?
I can't believe you have the shameless audacity to bring up Winger.
We have to mention it every show. All right. Anyway, I do agree with the author when he states that investments tend to go up with time, particularly over most 10-year periods. Again, it's not guaranteed, but I'm just talking about historical returns. So as we've discussed in previous episodes, sometimes it's good to go long on equities if you feel that you and or your financial advisor have put thought, effort, and due diligence into your investment selection. So, because obviously if you sit there and listen to the projections, 13% off, that would be like, that's so far off, it's not even worth hardly even paying attention to.
Good at all.
It's not good at all. All right, what's next?
Okay, so we just discussed a Business Insider article that claims the stock market is going to crash. And I'm going to jump off one end of the seesaw and go the other way with my next article.
All right.
The News and Observer site has a recent article titled, "When Will the Stock Market Recover?" We'd all like to know. Here's what experts predict. Josh, this article specifically states, and I quote, "Many experts agree that the worst of this bear market is over for stocks." This is the exact opposite of what the other guy had to say. So which is it? And are we headed for a market crash or for a bull market?
So we've had two articles.
I'm going to vote for crash.
Basically, I think both articles were written within a few weeks of each other. One guy says 25% decline in both stock market and housing. The other one says the bull market's or the bear market's over. Everything's going to be fine. All right. So I will say this. Here's the position of this article. They're saying that the upside is we have a strong labor market, which is true. We have stock valuations that are more in line with reality than they were during the past bull run. That's also true. And those two things should, in theory, make any recession fairly mild. It's also true that stocks rarely decline 2 years in a row. To the best of my knowledge, that's only happened 3 times since the Great Depression, I believe. So let's hit this thing on the head with 2 primary points. One, predicting the stock market in the short run is very, very tough to do, and those that do it are often wrong, way wrong at times. And 2, this is a great example of why dollar cost averaging is the typical investor's good friend. What is dollar cost averaging? It's the first time we talked about it on the show. It's called DCA for short. And why am I even saying that? Why am I bringing it up?
Because you love acronyms.
I do, yeah. DCA, dollar cost averaging, is the practice of systematically investing equal amounts of money at regular intervals, regardless of the price of a security. And so if you've ever had a 401k or 403b, in Michelle's case, and they take money out of your paycheck and they put it into your 401k/403b and they buy securities, you by very definition have done dollar cost averaging, right? Okay.
Yay
very
me.
good. Right. And what that tends to do is that levels out the price of the securities that you buy over time. So let's say that both this author, who's very positive, glass half full, and our previous author, the economist, who is definitely glass half empty, let's say they're both right, which means that we're looking at another year of ridiculous volatility where they both at various times can point to themselves and say, look, I was right, at least for a couple weeks. What you do with dollar cost averaging, you smooth out that overall price that you pay for your basket of securities. So I will say this, we can help with that at Gulf Coast Financial Advisors, 251-327-2124. Great article, Michelle. I'm feeling better now. Glass half full. What's next?
Good grief. All right. I thought this back and forth on opinions is just pushing me back to my new best friend, which is financial writer, Jeff Sommer.
Jeff Sommer.
Yes. Okay.
Good.
He had another recent article, again in the New York Times, with what I think is a brilliant title after some of the discussion we've had today. So the title is, When You Think About Investing, Don't Think About the News. I love this.
Right?
Yeah. I mean, news is bad. So Jeff interviews economist Richard H. Thaler, who apparently is University of Chicago professor that won the Nobel Memorial Prize in Economic Sciences in 2017, which I had no idea that award even existed.
Me either.
Okay, great. So I found this article very enlightening, thank goodness. And we could have possibly devoted most of the segment to it, but I guess I'll just focus on the part where we could have, they discuss asset allocation and the risk an investor can handle. So what are your thoughts on asset allocation, Josh?
Okay. All right. So great. So first, Michelle, as someone with an economics degree from the Harvard of the Midwest, otherwise known as Missouri State University, and someone that is unafraid to express strong opinions, hence our next segment where we talk about when I was right and wrong. I love that this author interviewed Professor Thaler. Is that how you say it, you think?
I think so. I'm going with it.
Yeah. He's both an economist and he's obviously unafraid to express strong opinions. He's just got a little bit bigger audience than I do. The fact that Professor Thaler went on a financial news show apparently last year, and when the host asked him, what TV show should investors tune into when the stock market goes crazy to get advice, he said they should tune into ESPN.
Yeah. I put ... or Hallmark in my notes.
Right.
Yeah, feel good stuff.
Well, so anyway, back to one of the main points that he makes. They talk about asset allocation. In our world of investment management, that simply means that it refers to what is your mix of equities to bonds in your portfolio, 60-40, 70-30, 80-20, so on and so forth. Now, there's a lot of flavors to this mix. And if you want to see our previous discussion in this episode about the differences between growth stocks, dividend-paying stocks, and preferred stocks, you can kind of see some of the differences just when you just broadly say equities. And Lord knows there's all kinds of different quality of bonds out there. But in general, if you set what happened to bonds in 2022 to the side, in general, having more bonds or fixed debt instruments or fixed income instruments in your portfolio tends to smooth out the roller coaster ride of gains and losses. Especially if you're in or near retirement, if you're watching your investments go up and down and it's more movement, more volatility than you're comfortable with, then chances are you are heavier into equities than what your risk tolerance would dictate. Now, there's good news with that. We can check that fairly easily and fairly quickly and definitely confidentially. We have a tool we use called Riskalyze, where we basically do an MRI of your holdings compared to what your actual risk tolerance is and time horizon. If you're interested in having a free Riskalyze done on your portfolio, give us a call, 251-327-2124. All right, very good. Economists, opinionated. I like it. What do you got next?
Okay. Hooray, Jeff Sommer. Welcome to the club. Okay.
Yeah.
Welcome to the show.
I have a feeling we'll be referencing him again.
Right. Okay, finally. Woo! Well. I left the last article choice up to you.
I didn't do Kiplinger this time. Thank you.
You've already mentioned that.
Yes, I got Kiplinger in, but I didn't do Kiplinger.
Same. And yeah, it's all the same in my brain.
All right.
Like the bears on the unicycles in the circus tent. So, all right. So I leave it up to you. And you have the shameless audacity to pick yourself.
That's right.
Sort of. So our last article headline this week will come from your website, GulfCoastFA.com, specifically for the For Investors page. I will say that the first thing that jumped out at me on this site was your discussion about investment philosophy and having core and satellite portfolios. A lot of syllables. Okay. I also like how you had an easy to follow chart of your different investment portfolio options. I also like the Sustainable Series portfolio, by the way.
Yes, there.
So,
right.
All right. So, since this is your site, tell us about it.
Well, so the main point of that site is to talk about having an investment strategy and a philosophy versus just trying to get lucky or time the market. But before I talk about the specifics of the page, I do want to make it clear to our listeners that all investments involve risk. And just because I am willing to be super transparent with how we handle our investment portfolios by putting it all out there online, it's not intended to just be a broad billboard advertisement that you would see driving down the road. It's really intended to try to be transparent and try to show that we approach this with a lot of due diligence and thought and care. And we try to be, we are a fiduciary when it comes to our investment portfolios. So with all that said, here's what we mean when we say core and satellite portfolios. Michelle, you remember how we talked earlier about asset allocation?
Yes.
Equities versus bonds? Well, our core portfolios are intended to provide exposure to a mix of equities and bonds, and it's really meant to be dialed in to match the individual investor's risk tolerance. So we have these different core portfolios, and they run from conservative to aggressive and all points in between. The satellite holdings are meant to diversify away from those core holdings, often allowing what's intended to allow an investor to have a particular goal in mind. For example, income production in retirement. We have a satellite portfolio that is intended to try to accomplish that. So in other words, the core holdings are the foundation of our portfolios, with satellite investment portfolios added to complement those. And all this is designed to meet the risk tolerance and the long-term goals of our clients. Our goal is to work with you all to help optimize your overall investment portfolios by maximizing returns while minimizing risk per your risk tolerance and your time horizon. It's what is known as the efficient frontier. It's not anything that's guaranteed, or it's not anything you're just going to stick the land every
like
time.
space, the final frontier,
yeah, a little bit,
or
yeah.
is it?
Well, it's a graph chart, which gets my economic head going crazy. So, of course, again, this is not guaranteed that the portfolios, allocation, or strategies will always be profitable. Everything involves risk. Past performance, no guarantee of future results, all that. But it does mean, again, that there's some care, thought, experience, and due diligence put into our investment choices. So yes, I did self-gloss a little bit there. So, all right. Michelle, great job with the headlines as always.
Woo!
Yes, these are all important pieces of information that impacts those who are in your retirement, or just investors in general, honestly. So listeners, if you have any questions around the topics in our headlines, or the headlines of the week, or you have questions related to your investment strategy or financial plan, why don't you give us a call at 251-327-2124 to set up a conversation or make an appointment. And of course, you can always email me at jnull@gulfcoastfa.com. All right, folks, coming up after the break, we get to have a little fun, and I'll probably get picked on a little bit by my co-host, Michelle.
Of course.
Our next segment is called Where Josh Nailed It, where Josh was a little off. As someone that has always had strong opinions and often public opinions, I think it's important to hold myself accountable for the things I've said in the past that didn't quite stick the landing. But to be fair, we also discuss my often skeptical viewpoints sometimes prove to be pretty accurate, right?
That's right.
That's right. So remember, I am originally from the Show Me state of Missouri. So Michelle, what does that mean?
You have to prove it. You have to show me. You can't talk.
That's right. Don't tell me. Show me, buddy. All right. Stay tuned.
Hi, Michelle here. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast Financial Advisors a call today and schedule your no-obligation in-person review with Josh and his team. Maybe it's time for that second opinion. Make sure to call 251-333-5151 or visit us on the web at gulfcoastfa.com. That's GULFCOASTFA as in financialadvisors.com.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
So welcome back. So the point of CoStream Retirement is to offer general financial guidance, not specific financial guidance, and really broad education to those in or near retirement, which means by default, I often have to give my professional opinion. Why else would we have a show, right? I'm very proud of the thought, care, and due diligence that I put into giving this professional opinion and the experience, both on the show and in my financial planning practice. I'm also very human, which means that I don't always stick the landing perfectly. So each week, Michelle and I get to poke a little fun at some of the things that I've said, and I admit to any thoughts or opinions I put out there that weren't 100% on point, but this is not just where Josh was a little off, it's also where Josh nailed it. So I also get to point to some of the thoughts and opinions that I've said in the past that were pretty accurate. So with all that said, without further ado, Michelle, what do we got first?
Okay, Josh, just last week we talked about the Silicon Valley bank Splat and how its troubles were most related to being extended in long-term mortgage securities that lost value as interest rates rose. And this was a relatively recent phenomenon. Now, with more information emerging, it's looking like that SVB was being warned months ago to shore up its finances, and there appears to be at least the possibility of some of the executives selling stock while keeping this bad news quiet. I read about that too last week, and then I got the CEO was on vacation in Europe, so I support that statement. But anyway,
Right.
So I nailed it. But so did you nail it with your opinion that long-term bonds were the primary reason for SVB's collapse, or were you a little bit off?
All right, so, okay, here's the thing. Even with this new information, the primary bank run was triggered by a loss of confidence related to SVB having to sell underwater mortgage securities at a loss to generate cash. So on that part of my opinion, I still feel like I nailed it. But I think it's fair to say definitely a little off and not mentioning the missteps of the bank's executive team. If you listen to that episode, I probably went a little light on them. To me, it looked like from the outside looking in that they just kind of got caught with their pants down, made a bad choice, went too long on things, didn't find enough quality things to make loans on, so on and so forth. But looking back now, it absolutely looks like they knew things were not great and they were selling bank stock as it went along. And I have a feeling, again, you're always innocent until you're proven guilty, but this definitely is teeing up on something that might be a clawback on some of this stuff. Would not surprise me. So yeah, nailed it on the bond opinion, definitely missed it on the accountability and the missteps of the executive team. Very good. What's next?
Okay, Josh, you have stated that the clients that become financial planning clients tend to weather bad financial news a little smoother than those investment management clients. What do you mean by the statement? And did you nail it, or are you a little off with this opinion?
Well, so we named this article, we named this episode, Everything, Everywhere, Financially Falling Apart All at Once, right?
Yes.
Right. And honestly, if you're just
all last week.
Yeah, if you're a day trader, if you're a do-it-yourselfer, if you have maybe a relationship with a broker that is, trying to be kind of a whiz kid, if you will, it probably does feel like everything everywhere financially is falling apart at once. The difference is for somebody that comes in, and we do have clients that that just engages for investment management. Now, some of the time that investment management for the folks that are in accumulation phase is going to be related to, hey, how do we scratch and claw out the most capital gain we can get, right? That's what you're looking for in your 403B. But sometimes we have investment management clients that are trying to accomplish different goals. They're trying to preserve capital. They're trying to generate income, all different things that we have with our core and our satellite portfolios. The difference are that there are a lot of similarities between an investment management client and a financial planning client. And often the two, we have a bleed over of both. A lot of times somebody will start out as an investment management client. They will transition to financial planning or vice versa. Usually we have a relationship on both sides of that. The financial planning client, though, in general, not always, but in general, they're going to see the investment piece, their investment portfolio as one piece of the overall puzzle. And that kind of helps put it in proper context. Not that you want to diminish it, because a lot of your wealth, your overall wealth, is going to be determined on your investments. But when you know it's part of a larger puzzle, that's going to involve some tax planning, that's going to involve some wealth management, that's going to involve looking at tax returns, it's going to involve looking at various trusts, all these different things that come into play, then you understand that it's just one piece of the puzzle, and you tend not to lean on it as much as somebody that is simply looking at why did my stocks go crazy today, or why is my portfolio down 20%? It's a little bit different discussion. So, all right, very good.
So
What you got?
hybrid clients.
Well, not necessarily. No, I mean, a lot of times when folks are in accumulation mode and they've got a 401k, or in your case, a 403b,
Yes.
yeah, you could open up an IRA with a financial advisor. It would be kind of silly, kind of pointless.
Okay, good to know.
Right. But you still could use a financial plan, right? Now, when you get a little bit, or if you're somebody like me, self-employed, if I wasn't in my line of work and I needed somebody to help guide me to accumulate money in an investment account or an IRA or a simple or a SEP, then this would make sense. And then as you get older, you're no longer working, contributing to that 401k. You want to take that money and put it into your care, custody, and control through a rollover to an IRA. Pretty good chance not only are we going to help you on the investment management piece, we're also going to help you on the financial planning piece. So very good.
All right. So I think we've been more or less fair in our discussion around cryptocurrency, although it remains forever suspect to me.
Fair.
But specifically, Josh, you have always qualified that you truly don't know if blockchain has a future, but there's a lot of capital behind it for sure. But you also said that no strong sovereign nation would ever let its private citizens print its own currency or their own currency, and that you thought the speculation of crypto would continue to cool off, even with the crypto industry stalwart Bitcoin. Well, apparently Bitcoin prices have rallied the past week. So did you nail it, or were you a little off?
All right. So allow me to be fair while also still being skeptical. Okay. So yes, Bitcoin and other cryptocurrency prices have risen recently. So in regards to that, I was a little off, at least in the microcosm of the last week or two. But like you said, Michelle, we've been specific in our criticism of crypto in that no one in or near retirement should have a significant portion of their investment portfolio in such a speculative asset. And no one's going to talk me off that stance. I plant my feet on that. Now, to be fair, I don't follow crypto that close. To be honest with you, all the crypto bros kind of wore me out a long time ago. But I will say that as someone with the economics background, my guess is crypto's resurgence has as much to do with the realization that the Fed is going to have to cool it with its interest rate increases. We saw that today with only a 1/4 point jump, or they risk causing a true bank panic, bank run, and a market downturn. Here's the thing. Speculative assets, not just crypto, but all kinds, they tend to do better in a steady or decreasing interest rate environment. Plus, here's another thing. I don't know if you know this, Michelle, maybe not, because again, this one of the things popped up in my feed. There's a significant court case involving crypto stable coin going on right now.
Yes.
So again, to be fair, I was a little off in the short run, but we will see if in the long run I nailed it or was truly off on crypto. That's my opinion.
Right. Even Giselle was talking about that today, that she had no idea it was going to tank so bad.
Right. Well, yeah, she got sued.
Yeah. Not fun.
No.
Okay. All right. So way back in March and April of 2020, when the world was ending because COVID was shutting
Felt
down
that
the
way.
world. Yes, it did. March 13th, 2020 to be exact. Is when I was like, no more fun. Okay. So you decided to increase your online efforts significantly in order to give people as much financial information as you could during an incredible, difficult time. Rewinding back to that time, you vocally expressed that you thought the market would be down for some time and the chance of a V-shaped stock market recovery was quite slim. However, a V-shaped recovery was exactly what we had. So did you nail it, or were you a little off? I'm going to go with the latter and say you were off.
Way off. Yeah, way off. But here's why. The 2008, so I was a home builder. I was in real estate through the 2000s. The 2008 housing crash, just put me out of business. It was over. It was done. And when this thing with COVID happened, two things struck me. One was, this is going to be a lot like 2008, where it's going to take the market a long time to recover. Way off on that. I mean, just the ultimate classic V-shaped recovery on that. And two, the part where I think I was a little right was, I'm proud of the work that we did. And I want to give due credit to my RIA, the investment company that I work with, Prime Capital Investment Advisors. There were several people there that jumped in online with me to help get as much information out to people as quickly as we could online. A lot of people were, indoors and they only had access to their phones or their laptops. And I really feel like we did some good work. I mean, to be honest with you, Michelle, we picked up a lot of clients there at time period. So we must have been doing something right? But I felt like if somebody had done that for me in 2008, that had been through some of this stuff before, been through a crisis like this, it would have helped me. So I felt like I kind of had to pay it forward a little bit, and I'm glad that we did it. But as far as predicting, I was more like what was that guy, Eeyore? I was more like a Dr. Eeyore economist. I thought it was going to be pretty rough for a long time, and I was wrong. I mean, we're going through some struggles now, but in that particular moment, we had a V-shaped recovery. So I was a little off.
back then. We'll see about the here and now.
Yep.
Okay. Last one. So, using annuities as a hedge against potential losses in stock market volatility. What was your opinion in the past? What is your current opinion? And did you nail it, or were you a little off with said opinion?
Well, so here's the thing. I came up, advisors in my line of work, generally speaking, come up two different lanes. They either come up on the insurance side or they come up on the investment side. A lot of times on the investment side, they'll come up, they'll start at Ed Jones, they'll progress on, maybe they'll move to Merrill, maybe they'll stay around at those wirehouses, brokerage, maybe they'll go independent like I am. They'll go that route. I came up the insurance route. I started working with the mutuals, and then I went independent and kind of came that direction into the investment side of it. So the reason I'm telling you that is I know the insurance industry very, very well. And as a result, I have a little bit of skepticism about some of the things that at least maybe if they don't promise, there's too many agents out there making promises that I'm not sure they can keep. So anytime that we do utilize insurance products in our practice, we make sure that everybody's eyes are wide open and we all read the fine print. All right. So that being said, in the past, I was, when the market's on a long bull run, when the economics look solid, I just really couldn't see the value of putting people into something that would have, they'd lose some liquidity. Maybe they would gain some certainties, they gain some income, but not that I didn't ever use them, but I almost had to talk myself into it. Sometimes the client talked me into it because that's what they wanted. Fast forward to where the last couple of years, not only have I gotten a little bit older and your opinion on things changes as you get older, but it has been scratch and claw to get gains. And there's been many times where it's been about trying to just preserve capital. So to be fair, so one, to answer your question, Michelle, the long-winded way of saying this, I was definitely off, but here's why. It took a little bit of perspective and a change in the market and a change in a growing of our practice and everything, conversations with our clients, to where if you've got a reputable insurance company and they're offering something that protects the downside to a certain degree, that 0% is typically how most of those companies do, and still allows at least some type of participation on the upside with what's called a cap rate, then it's a lot of time, and also has the ability to generate income. As long as you've got a specific job for that tool and you're not coming in and trying to say it's the greatest thing since sliced bread and it does all this great accumulation, capital accumulation is really not what they're for. As long as you've got the specific tool and you're not just a hammer looking for a nail, then I think they've got a place. And that's basically how we've been approaching it. Open, eyes wide open, and open and honest conversation. So anyway, on that one, a little off, but as always, I'm learning, I'm growing, right?
Evolving. That's Yay.
Right. All right. Well, listeners, once again, I obviously didn't totally nail it with all of my opinions, but as you've seen, I had valid reasons for being a little off. I'm learning to be more open-minded, right? Impressive
Not
maturity.
a bad thing.
Would you say? Yes. All right. So now to our listeners that have more questions about these types of things, about the things that we discussed in our right and wrong segment, why don't you give us a call at 251-327-2124. You can make an appointment there or just have a conversation. You can also find us online at gulfcoastfa.com. All right, folks. Breaking news. Michelle and I cooked up a new segment for you all. Now, regular listeners of the show or anyone that follows us on social media will know that both Michelle and I love living along the Gulf Coast down here in lower Alabama. We're outdoor people. We love to hike. We love to camp. We love to take the boat out, go to the beach, you name it, right? So in this next segment, we are going to dive into some of the specific reasons we love this part of the country. Plus, we're also going to give you some tips and some pointers for things to do while you're down here. I mean, who knows? Even some of you natives may learn something new, right? So stay tuned for our next news segment. We're calling it Living the Gulf Coast Life. Stay tuned.
Retirement is full of decisions you need to make before you actually retire. When should you take Social Security? How are you going to pay for medical expenses and long-term care? Are you comfortable with the amount of risk you're taking with your savings? Join Gulf Coast Financial Advisors as they lead a discussion about these factors and more. All while the Gulf Coast team treats you to a complimentary dinner at the Balcony in Fairhope. You pick the date, Tuesday, December 6th or Wednesday, December 7th at 6:30. Reservations are required, so call 251-333-5151 to reserve your seat today. That's 251-333-5151. Seating is limited, so call now. Gulf Coast Financial Advisors, 251-333-5151.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
All All right, folks, welcome back. We got a new fun little segment called Living the Gulf Coast Life. We're going to give it a shot, see how it turns out. And basically, Michelle and I are going to talk about things of interest locally here in Lower Alabama. We're recording in Daphne, Alabama. We both work, and Michelle lives in Fairhope, Alabama. It's across the bay, Mobile, Alabama, all this stuff. Now, for you local listeners, you're saying, well, why are you describing all this? We have listeners that are from out of state. We have listeners that have never even been down here. So this is going to be a little bit fun. Let me tee it up. Michelle, we're going to get in and out quick on this. Fairhope, Alabama. Now, for anybody around here, obviously Fairhope's very well known, or anybody in the Southeast, I would say.
I don't know if that's true because I hadn't heard of it until I started shopping around to.
Oh, okay.
Yeah.
Well, they say the secret is out, right?
It is now.
It is now because Fairhope, Alabama, where my office is located, where Michelle lives and works, just had a 6-page spread in Southern Living magazine.
We're basically in Southern Living twice a year for the last 5 years.
All right, so let's do this, Michelle. So let's quickly talk about what, give us a description of Fairhope. What were your thoughts on the article? And then we'll jump out from there.
Okay, well, Fairhope is also known as the Utopia by the Bay.
Right.
I liked it. It did have good history in there that a lot of people don't know.
The single tax colony.
The single tax colony.
Right. About 4,500 acres it covers.
Yeah, a lot of creative people came down. They were sick of taking everybody else's mess. So they were a whole bunch of free thinkers. And they came down from Iowa, one of your favorite states, I believe
just north of Missouri.
And they landed here or stopped here because they saw the big, beautiful bay. And it was on the safety of the bluff which we have here, which is correct. And the water was probably clearer then.
Oh, I bet.
And apparently it was chock full of seagrass in Jimbo's life earlier on, but I've never seen that. Rick Bragg, the writer, said he would never get in the bay. I've water skied in the bay, sailed in the bay, catamaran, all that good stuff. Right. I'm fine. My legs did not rot off or anything like that, so we're good.
Well, I think one of the things that they did that was really far thinking, because you're talking about the 1890s, they came down, right?
Yes.
They made it where there was no development on
the coast. The coast belongs to the
2 miles.
Yeah, to the the whole stretch.
Well, okay. So to be fair, you're city planner for the city of Fairhope. So if anybody knows ground in this area, you know it. So just talk about that a little bit. How unique is that? What does that do for you as a citizen and a resident of Fairhope?
Well, they had the foresight to not develop it so what our bay beaches don't look like our beaches in the southern, more southern part of the county, which is fine. That's great, but that's for them on the Gulf of Mexico, but they decided that should be for the people, protect the vistas. They set aside a lot of property to maintain as parks. They gave all the gullies to the city and all this green space that they assigned to the city, but they still have so many leases because they have 99-year leases on the colony property, and they still acquire property.
Yeah.
And the Fairhope single tax is kind of neat in itself. I think there's only 2. It's the largest.
Right.
And there's only a handful.
I think there's only a couple left at this point.
Yeah, exactly.
I think it's pretty unique.
Yes.
A lot of times they fall apart, but ours is stronger than ever.
Ours is stronger than ever. Right. And they are really park oriented and they build sidewalks and stuff like that too. So it's
great library.
Libraries firsthand. It's really cool. Doing a lot of good stuff.
Well, I mean, for the folks around here, everybody can point to Fairhope. It's wonderful. For the folks that are not familiar with it or haven't visited, it's definitely, Michelle and I talked about the bay. There's also a great downtown.
Yes.
And if you do come downtown, just walk around the corner and you'll find my office, 413 Johnson Avenue. So there's a little selfish plug.
But it's still a place for creative minds to hang out. It's still attracting those type of people. They say that we're a drinking town with a sailing problem, but part of this article said, also went on to say that we have more writers than readers here now.
I love it.
Yeah.
That's great.
So it's pretty neat. So, and you can't help but to visit because we keep on showing up everywhere. Yep.
Well, folks, you can find that article on Southern Living's website.
And it's Rick Bragg. He actually is a local.
Yeah. And he has an interesting way of writing. I really enjoyed it. Right.
Yes.
So, well, folks, that's it for us this week here on Coasting in Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton. Thank you. Right. Thank you to our awesome radio station, 106.5 FM, Talk FM. Many thanks to the provider of our show music. That is local band Sloth Racer. Sloth is in the slow-moving animal, even though the music is not slow. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We would love to be a part of your journey as well. Until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory products and services offered by investment advisor representatives through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA at 6201 College Boulevard, Suite number 150, Overland Park, Kansas, 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. Certain services may be provided by PCIA affiliates. In this format, Josh Knoll provides general information, not individually targeted personalized advice, and is not liable for the usage of the information provided. Exposure to ideas and financial vehicles should not be considered investment advice or the recommendation to buy or sell any of these financial vehicles. This information should also not be considered tax or legal advice. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested.